external finances have worsened in the last couple of weeks, with oil prices rising from $75 a barrel to $85 to $90 range. And then there were rice bans, because of which exports have come off. Rice was an important part of India's export basket. And then on the flow side, there have been outflows from the equity markets recently. FDI has been weak. Loans are not getting refinanced because a lot of people now want to just borrow domestically, given global rates are so much higher than before. And we're also seeing remittances slow a little bit. So all of this means that India's balance of payments, which was in surplus for the first half of 2023, is likely to go into deficit in the second half. So that puts pressure on the rupee, and I think there's pressure for the rupee to weaken. But the RBI is standing strong. It has a huge wall of FX reserves, and it is using that to keep the rupee as stable as it possibly can.
Pranjul, how would you characterize moving forward the interplay between fiscal policy and monetary policy heading into the election next year?
Well, I think that's a great question, because whenever an election is close by, then there's pressure to spend on the fiscal front. We've seen El Nino hurting rural incomes, and I think the pressure to give some rural social welfare scheme will only increase in the next couple of months. So the government has to make space for that. And the central bank has to keep that in mind, because you can't have both fiscal and monetary policy being loose, and the monetary policy will have to overcompensate by remaining tighter than normal. And my sense is they're not going to be hiking rates right now. That's not our base case, but they'll keep liquidity tight, something they've been doing. They've actually given a de facto 25 basis points rate hike in the last 6 weeks by just keeping liquidity tight. And I think that's going to be their aim going forward.
All eyes are going to be on the inflation commentary. And Pranjul, all those inputs that you mentioned are really muddying the waters. What's your take on how quickly inflation could come to the RBA's target?
Actually, optically speaking, inflation is going to be falling in the next couple of months because of base effects, because of vegetable prices that have fallen in the last couple of weeks. So things are going to look good. We've had the El Nino, which is a macro story, but there have been some micro weather events as well. For example, the Indian Ocean dipole, the MJO, a new phenomenon, which has brought back some rains in September. So things are not looking too bad on the food inflation front. It's better than before. I think the worry has now shifted to oil prices, and if high oil prices and other commodity prices spill over into core, I think that's the worry. In terms of RBI target, look, we could come close to about 4.5% in the next couple of months, but I don't think we are anywhere close to the 4% RBI target. So from that perspective too, it's better that the RBI remains more hawkish at this point.